Hello everyone, it's Professor Reiko here. Today we are going to continue on with our chapter on our long-term liabilities, focusing on bonds. And this one, this lesson right here, this example we're going to work through is on accruing interest. Okay, so accruing interest just means making sure we get interest expense in the correct time period. So let's just walk through this example and kind of see what we're talking about here. All right, so we got a company. They sell 10% bonds having a maturity value of $2 million for 1.8 roughly million. Okay, so notice this one, it's telling you the present value. So right away, I know that this number is 1,855,816. Okay, which is going to make the discount at the beginning 144,184. So I didn't have to calculate the present value in that. Okay, the bonds are dated January 1. Mature 5 years from now. Notice it says interest is paid annually. I did that just to speed things up here a little bit. Create an amortization table and prepare journal entries for the issuance. All right, so as we always do in problems, I like to just come and figure out the interest payment. All right, so remember, principal times rate. Remember, the only time we use the stated rate is when we calculate this interest payment. Now, I've been putting times 6/12, but this one is annually, so technically it's times 12/12, which is 1. So you really didn't have to have it there. All right, meaning the interest is 200,000. All right, so that means every year the interest payment would be 200,000, and that would be for the life of the bonds. All right, so if you notice here, to get interest expense, our definition says that we calculate interest expense beginning of the period carrying value, which we know, times the market rate. Well, if you notice in this problem, there's no market rate given. So how do we go about doing this, all right? So I do this in class to point out, using your financial calculator, if you know 4 of the 5 keys, you can get the 5th key. Meaning, if I come here and say, I'm just going to scribble it where I've got room, maybe right here. So I know the future value is 2 million. And that's going to be a negative 2 million. All right. I know my payment is a negative 200,000. Once again, I put those positive and negative as they are a cash flow to me. We're the ones that are going to be paying back the principal at the end. We're the ones paying the interest. All right. This one, we're usually calculating present value, which is the issue price. But this one, I know it. 1,855,816. We know the number of periods, it's annual, so it's 5 periods. And then if we compute the I, it's going to kick out 12%. Okay, so our market rate is 12%. So up here, we're going to multiply times 0.12, not 0.06. It's not semi-annual in this problem, so you just make sure you pay attention to that. All right, so the point being there, as long as we know 4 out of the 5, we can calculate the 5th number, so that's fine. Now, we knew the rate. We knew already that it was a if you look over here, we knew that it was a discount because it was we issued it for less than face value. So that we knew from that the market rate had to be greater, and it is. It's 12%. All right, so let's do our first. It says the journal entry for the issuance and the first interest payment. All right, so on January 1 of what year is this? 17. All right, we have cash. We have discount on bonds payable. And we've got the credit to bonds payable for face value. Notice how this journal entry is the same every time. We've just changed back and forth between discount and premium. All right, so 1,855,816. This is 144,184, and this was the 2 million. All right, the first interest date on 12/31. That should actually be 17 again. That's the end of the first year. I keep having that typo. Sorry about that. 12/31/17. We're going to have interest expense. And then we notice that we're going to have discount on bonds payable. And we're going to have cash. All right, so I haven't completed my table, so the only number I know right now is 200,000. But I did that to kind of point out that we know the flow of these journal entries now. So if you have to write this out on test, you should be able to get the accounts right. And even if you mess up a number, you're still hopefully getting some partial credit. But let's go back up and fill in the table. All right, so remember, beginning of the period carrying value, the 1.8 million times 12%. That gives me 222,698, which makes this 22,698. All right, so I can drop these numbers in right now: 222,698 and 22,698. Now, if on a test I told you just to go through the first interest payment, I would actually stop the table right here because I don't need to know the rest of it. But let's just fill in just to kind of have a little bit more practice. 121,486, and this brings 1,878, 514, and then we would take this 1,878 number times the 12% and get 225,422, making this 25,422. This now is down to 96,064. Notice how column D is always going to 0, and notice how column E is always going towards face value. So this example on a discount would be going up. This is now 1,903,936. All right, so we can keep going on and on with that, but the point of this one is what we want to talk about is accruing interest. Okay, so if we look down here, accruing interest is just when a company reports financial statements at a point in time not coinciding with the two interest payment dates. Okay, so what they must do is prorate the discount or premium to get the proper interest expense. Okay, so what we're going to do, we're going to look back up here and we're going to assume that we're preparing financial statements on August 31st, 2017. All right, so what it means is we are in between these two rows up here. All right, whenever you are in between two rows, take the row after, all right, meaning this one, 12/31/17, and prorate those numbers. Okay, so what I mean by that, so just kind of see if I can keep it all in the view here. Yeah, so so what it means is my payment, all right, for the full year, it was 200,000. But I just want to know what it is for 8/12 of the year through August. All right, so that gives me 133,333. All right, interest expense for the full year was 222,698, but I just want 8/12 of it. So we'll prorate that number, 148,465. And so we can see now the difference here is 15,132, but I could also say that the discount amortization was 22,698, and I want 8/12 of that. So the math works either way we do that. All right, so those are my numbers. So if I'm going to do an accrual journal entry, that means I'm still going to recognize interest expense because that time has interest is a function of time and that time has elapsed. I'm still going to amortize the discount for 8 months, but now instead of having cash as my credit, I'm going to say interest payable. All right, so let me scroll down where I have a little bit more room. So that means on 8/31/07, so this is my, 8/31/17, this is my accrual journal entry. I'm going to debit interest expense, all right, for the 148,465. I am going to credit the discount on bond payable for 15,132. And then I'm going to have interest payable, because remember, this isn't an interest payment date. All right, so I'm not paying interest now, I'm just accruing it. So this accrual reflects that I owe it. The payable reflects that I owe it. But this interest expense right here is now put in the correct time period. All right, so when I get to 12/31/17, when I actually pay it, I would recognize 4 more months of interest expense and take the payable off the books. All right, so it says how would it be presented on the balance sheet. All right, so remember, it reported at its carrying value on the balance sheet. All right, so it basically say, it'd be bonds payable, and it would probably say net bonds payable. But remember, it's at its carrying value. So carrying value is face value, which is 2 million, less an unamortized discount. All right, so remember, our discount was, I'm just going to put brackets here. I know that's backwards. 144,184. We just amortized 15,132 of it right here. All right, so that's this right here represents our unamortized discount. All right, so it'd be on our books at 129. I'm sorry, it'd be on our books at 1,870,948. Right, so that's what it would be on our balance sheet as of that date, because we'd have to catch everything up to that point in time. Now look, the problem didn't ask for this, but if we jumped ahead to 12/31/17, we would have interest expense. All right, and this, I don't know the numbers off the top of my head. I'm just going to put parentheses. That'd be 4 months of it. So the other 4/12, whatever that works out to be. We would take the interest payable off the books for 133,333. We would have the amortization of the discount on bonds payable, all right, for the other 4 months, all right, and whatever that works out to be. And then we would have the cash payment for the full $200,000 payment. Okay, and then we would just start that process over and over again. All right, so make sure you really understand that. Always pay attention to your dates on test. If you're ever in between your rows on your amortization table, take the row below where you are and then prorate those numbers to do your accrual entry. Okay, so this is kind of one of those important things you really need to pay attention to because if it hits you on test time, really be ready. You really need to be ready to be able to handle that on a test problem. All right, so hopefully this helped dealing with accruals of the interest expense and pulling the numbers from the effective interest table. All right, so I hope you're enjoying this. Please subscribe to the channel. I'd appreciate it. It does help me out. And, please share these videos with your friends and encourage them to watch as well. And hopefully you're finding them helpful. I'll see you next time.